All right, perfect. Fair value gap session number 2 of the fair value gap enrollment. So let's move on to section 1. Let's see. All right. Section 1, I have written down open your mind. And this is quite an important topic that I want to start off with. And the reason being for that is because I've also done similar things on YouTube. I have been teaching for quite a while now. And when I teach concepts, people always assume that it's going to work 100% of the time and it should exactly be like that, like Aryo said. Otherwise, it's just not valid or it's not going to work. And this is not true. I need to open we need to open your mind more. And what I mean by that is this is not something about mechanical trading. So everything that I mentioned right here is not going to work 100% of the time. Everything that I mentioned right here is not going to be 100% exactly like that all the time, because otherwise trading would also be very easy, right? If it's always constantly the same, it would be very, very easy and we could just use algorithms and we would be extremely profitable. But that's just not the case, because price action constantly is different. So the skill in trading is not necessarily, all right, can you learn as much rules for your mechanical trading to then be as profitable as you can be? No, it's a skill. It's truly learning and being able to read price action. It's a skill. How much experience do you have? How much different scenarios have you been through in your trading to be able to recognize different scenarios? That is the skill in trading. And this is exactly the reason why we say our trading plan is 80% mechanical, 20% intuition experience. The reason for that is because 100% mechanical, I have tried it in the past, it does not work. Yes, you can make it work. The profit margins overall are very minimal. The win rate is not that great. It's not something you would want to do. So in order for us to have the best trading experience, we also need that 20% intuition. And the intuition, the 20%, is where the potential is. It's simply said where you will make the most profits, where the win rate will increase a lot. But that can only happen if we stick to the same thing. And we need to be aware of that, again, the reason I want to make this slide is because a lot of traders, when they come into the industry, they think, all right, if I learn this concept, it needs to be exactly in this manner all the time and it's going to work every single time. It's not true. There's a lot of different variables to it. So that is exactly what we are going to go over today as well. So moving on to section 2, we need to go over the different type of fair value gaps. And as you may notice, I have labeled them as well as of the previous session, where we went over momentum and manipulation. That is what fair value gaps can do. Now, fair value gaps in itself, a different type of fair value gaps, can be labeled as momentum or manipulation as well. Where the first thing, to remind ourselves a little bit, the first thing we always expect from price action when we have a new fair value gap, we expect momentum. We do not expect manipulation, but we react and we can potentially anticipate manipulation at certain levels. For example, our entry pattern. That is when we can expect manipulation as well. So we have breakaway gap, momentum, overlapping gap, momentum, fair value gap, momentum. Manipulation gap is, of course, like it already says, manipulation. Mitigated gap is also manipulation. So that's not your usual momentum where you just expect price very easily to move higher or move lower. No, it's manipulation, so you expect the exact opposite of that. So again, all these gaps right here, they are fair value gaps. They're just labeled a little bit different. Now, the reason I don't necessarily want to be able to fully define these different gaps is because it really depends on what price action is doing at that moment in time. For example, if you have been following along with the advanced enrollment as well, then we go over a breakaway gap. And a breakaway gap has different variations. So there's not just one single variable that is a breakaway gap. And if we do want it to be one single variable, then that's going to be detrimental. That's going to stop us from reaching the full potential. That is very important. So we move on to section 3, where we go over the first gap, which is a breakaway gap right there. There are 3 steps essentially to understanding a breakaway gap. Where the first one is the question you ask yourself when you see a breakaway gap. And of course, we're going to dive into the details on what exactly a breakaway gap is. But the first question you ask yourself is the draw on liquidity or fair value gap. So are we first likely going to trade into the draw on liquidity that price is reaching for, or are we first heading towards the fair value gap to then go to the draw on liquidity? Is it more logical to trade into the fair value gap or into the draw on liquidity? A lot of times, if you follow along with the forecast as well, a lot of the times you'll see that I mention, all right, I do not think this is logical to currently make a retracement. Or I say something like, this is a very hefty retracement to make in order for us to then continue higher. So when I say that, I'm basically referring to a breakaway gap, where I do not think it's logical to make such a hefty retracement first to then head to the draw on liquidity. I think the draw on liquidity is going to get taken first. Then we have the third candle right there as well. It's the second step. Being able to keep an open mind and read the third candle is crucial. This is absolutely crucial. This is extremely important in order for us to read fair value gaps and what they actually want to do. And the third step is the lower time frame. The lower time frame will guide you in knowing if the draw on liquidity or fair value gap will be traded into first. So I want to go over this in a chart, and I'll touch on it really quick here in the PowerPoint as well. Where the first step is you see the fair value gap on, for example, the weekly time frame. And when we see the fair value gap or the potential breakaway gap on the weekly time frame, the 3 candles that we see, the third candle closing, already tells us a lot. But the lower time frame will tell us exactly what it actually wants to do. So what does that look like? If we go into trading view, then I first want to look at NASDAQ right here. And NASDAQ had a couple of breakaway gaps right here as well. But I mainly want to look at this one right here. Why is this a breakaway gap? When we continue higher right there and we create this fair value gap, this fair value gap closing above the third candle right there, closing above this second candle high, which is known, the second candle, as our expansion phase candle right there. And when we close above that second candle high right there, this now becomes a breakaway gap, potentially. And again, can you see how dangerous that is if I say that is a breakaway gap and we should never trade back into that, because that is just going to be detrimental and we are going to have a fixed bias. We are never going to change that bias. We're always going to trade sort of against the breakaway gap. And if we do want to trade back into it, then we just simply have to say, all right, it's probabilities. We can still trade back into it and we might continue higher. So there's nothing is ever set in stone. That's what I'm trying to tell you. It's very important to understand as well. So right here, this right now is what we assume to be a breakaway gap right there. We do not expect it to come back into that fair value gap to then continue higher off of that. We expect the draw on liquidity in the form of these highs right there to be traded into first before we might come back into the fair value gap right there. This is very important to understand as well. So what do we do here? Well, the first question we ask ourselves, because now we understand, all right, this is then probably a breakaway gap, right? So the probabilities are higher for us to first reach the draw on liquidity instead of coming back into the fair value gap. And the reason the probabilities are higher is also because since it is a breakaway gap, if we now do come back into this breakaway gap, it doesn't make a lot of sense and we might actually want to continue lower instead. So that's also a great indication on where we potentially want to be bearish instead. So right here, what are we reaching for first? Draw on liquidity or the fair value gap? Well, this is also where we are going to need the lower time frame. Where on the 4 hour, for example, we already had a fair value gap higher right there. So that already indicates we have a breakaway gap. We already have fair value gaps on the lower time frame. Lower time frame in this case, just any time frame below the daily time frame, because that is where the fair value gap was. Then that indicates to us, all right, now we can potentially already continue higher off of this instead of the daily fair value gap. Whenever we have a breakaway gap like that, what I tend to do is, and what I would advise to do as well, is I ignore it. I don't even see it as a fair value gap anymore. So this right here is not context, as in there is no daily fair value gap for me. On the 4 hour right there, if we have the 4 hour fair value gap higher, in first instance, of course, this would not be in context because, simply said, we do not have the daily fair value gap, or we have the daily fair value gap. That's the first thought process. But since this is not a valid breakaway gap, this is not a valid fair value gap to actually trade off of, then the 4 hour fair value gap is perfectly fine to use in this case. That's also very important to understand. Now, the interesting part here is that we already continue higher off of this, not off of this 4 hour fair value gap right there. The reason being is because we have another breakaway gap sitting there actually. And let me show you properly, because this is exactly what I mean, that we need to keep an open mind and we need to be able to read the candles instead of just being able to follow rules. We need to be able to actually become skilled traders, and skilled traders is something that comes through experience, not necessarily learning rules all the time. So right here, we see this fair value gap higher. And once we have this fair value gap higher right there, we have the third candle that does not close above the second candle high. But what does it do? Well, simply said, based on candle science, and again, if you are here in this live stream currently, then just understand, if you've not watched the foundation enrollment or advanced enrollment just yet, this might be quite confusing to you. Don't worry, that's completely normal, because this is also a follow-up of the foundation enrollment and advanced enrollment. Now, doesn't mean you should leave, but just understand that this is already very advanced. So right here, candle science is simply telling us right there that we already want to continue higher, because that wick right there, relatively seen to the overall candle, is already telling us that it does not want to trade into the fair value gap. The way the third candle forms is so extremely crucial to understand how fair value gaps are going to be used if we want to trade back into them, if we do not want to trade back into them. It's all in the third candle right there once we actually create a fair value gap. For example, we also have this fair value gap sitting right there on the 4 hour. And this fair value gap is extremely easy to trade back into it. Right there. Why? Because the candle is very small. The candle is extremely small. We're very close already to the fair value gap being created right there, where the path towards trading into the fair value gap to then continue higher off of that is made very easy for price action. Where here, price action would need to make quite a heavy retracement right there to then continue higher, because it's already displacing higher right there. So that is very important to understand as well. Then, if we go over one more example on the breakaway gap, I want to go over US dollar JPY, where we had this daily fair value gap sitting right here. And off of that daily fair value gap, we can continue higher. Now, you can probably see as well, you can see how easy price is making it to actually trade back into the daily fair value gap to then continue higher off of that right there. It's exactly what we would want to see. So when we come into that daily fair value gap and we go into the 15-minute time frame, and we have our 15-minute ST plus RE right here, then the first ST that we have right there is actually also a breakaway gap. And this is where we just continue higher off that breakaway gap. Now, for me, that is completely irrelevant. Doesn't really matter, because I'm just waiting for an ST plus a RE. So once we come back into that breakaway gap, I'm not being extremely picky and saying, all right, but that was a breakaway gap, so it shouldn't have traded back into it. So why did we do that? Doesn't make any sense. No, I see that just a fair value gap. We just have a rehire. That's it. So again, it's very important, and I'm trying to sort of get your mind to see that, yes, this is extremely important to understand, the breakaway gap principles, etc. But it's nothing set in stone. Very important, because otherwise it's just going to be detrimental to you, and you might as well not use it if you're going to use it in that way. So here we have the ST, we trade back into it, and then we create the rehire. The re is this small fair value gap right there. Now, at this moment in time, I actually entered this trade. And once I saw this third candle right there closing like that, I knew I do not want to enter on the fair value gap itself. I want to enter on the creation of the fair value gap or on the order block. Sorry, not the breaker, on the order block right there. Because I do not expect a retracement into the fair value gap. Because looking at the third candle again, it is not setting up to actually trade back into it, even though technically speaking, it is not a breakaway gap, but this is one of those variation breakaway gaps where we would not expect a retracement into that fair value gap right there. That is very important to understand. So moving on from the breakaway gap section to the next section. Let's look at section 4. And in section 4, we are going to be touching on the overlapping gap. And the overlapping gap is where we go over the mitigation block, the order block, and the breaker block. The overlapping gap is not that difficult, as in it's simply said a fair value gap that is overlapping with a mitigation block, an order block, or a breaker block. That's all there is to it. So first step, it's important to understand when it's the highest probability to trade back into an overlapping fair value gap. Where if you followed along with my YouTube, and again, you don't necessarily need to do that, but if you did, then you'll see I mentioned an overlapping gap as a gap that is in a specific place with an order block, mitigation block, break block. That's not necessarily that relevant. The relevant thing right there, and that I didn't mention on YouTube, is when we want to trade back into the overlapping gap, not where's the overlapping gap. That won't help us a lot. It will help us a lot to know when we want to trade back into that and when we actually want to continue higher off of that instead of just a standalone fair value gap. So the second step is fair value. The overlapping gap is an area of fair value. This is always the case, and that will indicate us, or that will indicate and tell us a lot on if we actually want to offer fair value and continue higher, or if we want to take liquidity. So what does this look like in a chart? Well, I want to go over NASDAQ again, right here. And on a monthly time frame, let's look at it. On a monthly time frame, I remember this price action very well because we were sitting right here and we had two choices, because we had this breaker high right there, which then becomes this right here. This is the overlapping gap that we have right there, because this is the fair value gap actually that is overlapping with the high right there. Not this area, because this is not overlapping with anything. It's only the area, the fair value gap below the breaker high right there. It's the same for an order block. It's the same for everything. This area is an area of fair value. So once we come into that, we should respect this overall area high right there with the bodies, etc. We should only wick it to then continue higher off of that, because that is an area of fair value. And when we do not do that, then we can confidently say that we might actually want to target liquidity at the bottom. Now, this is your overlapping gap. Again, first step being, what is the most important part? The important part is to understand when we trade back into an overlapping gap. Because if we understand that, then on the monthly time frame right here, we have a lot of price action and we basically have a very clear draw on liquidity for the coming months, potentially. Where you wouldn't be stuck waiting for this month fair value gap to push higher, and simply because that is a fair value gap and we should continue higher off of that, then we just only follow a bullish bias for the next coming months and we just only take losses. No, always keep an open mind. So if, and this is a very simple rule actually, if we do not continue higher off of the first fair value gap sitting right there, can also be a breakaway gap, whatever it is, then we are going to come into the overlapping part. That is the rule. That is the highest probability thing to happen. So to dive into that a little bit more as well. This is the first line of defense. That is the first fair value gap, in this case, a breakaway gap that we come into, that we expect higher price off of. Remember, we are always expecting the momentum to continue, right? We're always expecting fair value gaps initially to hold. And right there, if we do not continue higher off this first line of defense, then we are going to come into the overlapping defense, where this fair value gap, for example, right there, that fair value gap area is not an overlapping defense. Why not? Because it's one discount array. That area is still one discount array, as in it's one fair value gap. It's a piece of a fair value gap. So if we are not continuing higher off of the first one fair value gap, which is also one discount array, then why should price continue higher off the second discount array, which is also one standalone discount array? It doesn't make any sense. There's no difference between this fair value gap and that fair value gap right there. So if price only wanted to continue higher off of one discount array, then it should have done so with the first fair value gap right there. And that leads me back to the story as well. Why does price actually then come into the overlapping part? Because that is the area of fair value. So if price is already retracing and it's willing to offer fair value fully, then this area right there, where the breaker high is, that is the full area of fair value to continue higher right there. Where this fair value gap, the second one right there, it's not logical for price to stop there. There's no reason for price to stop there and not come into the overlapping part right there. So when we do not respect the first fair value gap right there, then we are going to come into the overlapping gap sitting right there. That is still momentum. So we are still expecting higher prices as well overall. But what do we see right here? Well, we are respecting this breakaway gap currently. So when we are respecting this breakaway gap, do we already expect higher prices right there? Well, yes, that could be the case. The only thing is that now the lower time frame again helps us play a supporting role in understanding if we already want to continue higher off of this breakaway gap or if we want to come into the overlapping gap right there. So what does that look like? Well, going into the weekly, we see we never create a weekly fair value gap higher. All right, but to wait for the weekly, that's quite some price action, right? Because we can also see we already had a rejection actually, which could have been a nice trade potentially. There were definitely trade opportunities right there. But you need to know when do those trade opportunities stop? Because just because we move higher right there, and just because we have a rejection right now of the monthly fair value gap higher, does not mean we automatically always want to follow through all the way towards the context high right there. No. So we have order flow confirmed here on the daily. And again, potentially there were great trades going long right there, but you need to know when to take a step back. We have the same instance where we do not continue higher off of this standalone fair value gap. All right, not too crazy. Then we can come into the fair value area, the order block right there, which has the overlapping gap right there. Then we can continue higher off that. That would be our first expectation. Now, is this expectation going to come true? Well, let's see. We have first candle signs base right there, rejection, higher. Then the next candle, what should we expect? Higher prices, right? Because there's no reason to come back right there. It's the same as a breakaway gap, same as a fair value gap overall, where if you read the third candle, it's the same as just reading candle signs overall, because here you would also not expect a previous day low sweep to then continue higher off that. Doesn't make sense, because that is a very heavy retracement for price to make and to then continue higher. Price is already on the way to continue higher. So it doesn't make sense to sort of make a pit stop all the way back home and then continue further. Doesn't make any sense. That's not price's intention. Price's intention is always to wait, or well, sort of use the least amount of energy on any single price move. So what does that mean? Well, price is always going to do the easiest thing for price to do. Meaning, if it wants to continue higher right here, and we already have a rejection higher, then it should just simply continue higher on that next candle, because that's the easiest thing for price to do. If it wants to sweep that to then continue higher, it's not going to do that. Then it's just simply going to continue lower towards the next discount array. So once we see this, that is very suspicious. And now another argument comes in, because we now have created a bearish fair value gap as well. So these are early signs that we do not want to respect this daily fair value gap, overlapping gap, and the fair value area. Which means that on the daily, we are targeting liquidity in the form of that right there and in the form of that low. Which also means that on the monthly, we are not respecting this monthly value gap. We have early signs because of the lower time frame. So we don't need to wait for the monthly next candle close. No, the lower time frame here in the form of the daily already tells us if it is respecting the monthly value gap or not. So on the monthly time frame, then the next target becomes this high with this overlapping gap right there. So that is when on the daily time frame, you just have a very clear bias right here for the coming months right there until we reach that monthly overlapping gap right there. And after that, we can look to potentially continue higher off of that again. That is an overlapping gap. And the most important part right there is, again, knowing when we want to trade back into an overlapping gap. Not necessarily where it's located, because I think my 4-year-old cousin can understand where it's located, but my 4-year-old cousin can't understand when it is going to be traded back into. That is very important to understand. So before we go further into that as well, let's go over the next section. We go over section 5. And section 5 is a fair value gap normal. Just your classic fair value gap, your normal fair value gap. But we've gone over different fair value gaps here as well. So what actually is now a normal fair value gap, right? That's very important. Where the first one is, the first thing we need to understand is that we have a fair value gap and then the draw on liquidity. Meaning the breakaway gap, if we remember that and we go back 2 slides actually, we had the question the draw on liquidity or the fair value gap. So the question was there, where section 5 right there with the normal fair value gap is not about that question anymore. We are expecting the fair value gap to be traded back into before the draw on liquidity. So that fair value gap is going to be for us an area that we are going to continue higher or continue lower off of. It's not a question anymore. And that is very important to understand. It's almost obvious that we are going to trade back into the fair value gap to then continue higher or continue lower towards the draw on liquidity. Then the second question, or the second mark right there, is where, of course, the third candle, like the breakaway gap, reading the third candle is crucial. It is the most important part right there. So what does this look like in the chart? We can stay on NASDAQ right here. And when we look at NASDAQ, we can see that overall the drawn liquidity for a couple of months right here has been the all-time high right there. So we understand that is the drawn liquidity. So how can we deliver there? Well, on the daily time frame, we had daily fair value gaps continuing higher. Let me delete everything actually. And we had this fair value gap higher as well. This fair value gap higher right there. Why is that a normal fair value gap? Can we see how this third candle closes? Where in a breakaway gap, in a bullish fair value gap variation for a breakaway gap, we have displacement at the bottom half of the third candle. So to state that clearly, is that in a bullish variation of a breakaway gap, we have on the third candle displacement higher, essentially, based on candle signs. Where on the fair value gap normal, the differentiator between a breakaway gap is where we have displacement at the top instead of at the bottom. So right here, we have displacement at the top, meaning it is displacing into what? It's displacing into this daily fair value gap to then continue higher off of that. So here, it's not the question, are we going to come into this daily fair value gap right there to continue higher off of that to then reach to the drawn liquidity, the all-time highs? No, the question is here, all right, well, can we find an entry inside that fair value gap right there? Because for us here, it's almost set in stone. And again, you will also see sometimes we won't do that. But the highest probability thing here to happen is we will come into this fair value gap to then continue higher off of that. Which is again, noted by, or the first indication is that we do not close above that second candle high right there. But I need you to understand that that is not set in stone, because sometimes we will close above it and we will still trade back into it. Sometimes we won't close above it and we will already continue higher. So it's seeing that third candle and then applying candle signs to the third candle and seeing what it wants to do. Here we can see this is setting up very easily. We have displacement going lower because we have candle signs at the top right there, long wick. to trade back into the fair value gap to then continue higher off that. So here, the order is fair value gap, drawn liquidity, not drawn liquidity or fair value gap. No, fair value gap, drawn liquidity, where eventually we can continue higher off of that as well. That is extremely important to understand. And that is what makes a normal, quote unquote, normal fair value gap right there, your classic fair value gap. Now, if we move on to section 6, there are a lot of sections this PowerPoint, so stick with me. Section 6 is a manipulation gap, and these are probably more important to understand than just your momentum gaps. And the reason for that is because if you can understand manipulation gaps and you can understand mitigated gaps, then you understand where price does not want to follow through, indicating that you understand where you essentially, well, potentially, you could get involved, but you do not want to get involved. And when you understand that, it becomes very, very powerful. It's more powerful to understand where you do not want to get involved than understanding where you want to get involved. Because we can all understand, all right, I might want to get involved right here, but again, how you avoid most losses, it's not by taking more winners. Funnily enough, it's avoiding losses is by simply actually avoiding loss. And what I mean by that is taking winners is really not that hard, as in everyone can find a winner once in a while. But where most traders and beginning traders struggle is finding the highest probability conditions and avoiding losses in a sense. That is very important. Where if you just go out there and you apply every single concept here every single day on every single situation, yes, you're likely going to take more losses than you are going to take winners. You still need to differentiate what actually is the highest probability condition, and that is very important. Well, manipulation gap. What actually is a manipulation gap? First thing we need to understand is that it forms at a reversal area. Manipulation gaps happen at reversal areas. In other words, a reversal area is just a PD ray. So for example, the US dollar JPY example that we had, daily fair value gap right there is what we expected to trade into and potentially continue higher off of. Then on the lower time frame, manipulation gaps happen right there, simply because we are at a PD ray as well. Then the second step is fake momentum. The momentum is used against us. So again, because we make use of momentum, that can also very well be used against us, right? It turns into manipulation. So this is important to understand, because if you just follow every single fair value gap out there and you just follow every single fair value gap expecting it to be momentum to continue towards that direction, then you're going to get burned. And that is not what we want to do, of course, because we want to avoid those situations. Very important as well. Then the third step is this creates a sharp turn. So sharp turn, this eventually creates an ST, a powerful reversal that we use in the market. What does this manipulation gap actually look like? Well, we had a beautiful example on the dollar actually, and we even mentioned it, where on the dollar, we were expecting higher prices off of this daily overlapping gap right there. We had the overlapping gap sitting right here. Show it to you properly. We had the overlapping gap, which we expected higher prices from. With the mitigation block right there, perfect. In alignment to continue higher, this is the fair value area as well, right? So once we come into that, we expect higher prices. With this right there being the context high overall, that would be our first target, which is also a premium array. Now, I need you to understand, manipulation gaps right there happen in different forms, happen in our entry pattern, but also happen in the thing I'm going to show you right here for your overall direction, for your bias. And at that premium array, I am not expecting lower prices. At first instance, right there, I was expecting higher prices to continue higher towards that monthly fair value gap right there. So at this premium array, even though it is a premium array that we can continue lower from, and that's important because every premium array is an opportunity for price to potentially continue lower. Whether it's going to be a rejection or we actually continue lower is going to be our job to differentiate. So this premium array is where I was not expecting lower price in first. That's what I want to make very clear. So I'm reacting to the situation right there. I'm seeing the manipulation gap happen and then I'm reacting to the case. So here on the 4-hour, once we reached this high right there in the form of our context high, my first thing is, and the reason, or well, my thought process is, I want to see higher prices. And when I want to see higher prices, what is the price action I want to demand off of price? What would price need to show me in order for price to say, all right, I do still want to continue higher? So the price action here that I would want to see is simply a close above this premium array right there. The next candle, ideally, I want to see another candle going higher right there. Why? Because that leaves a perfectly overlapping gap with the fair value area right there, where we can see this next candle is a down candle, which I already do not like. That is very suspicious, and that is just overall seen as a lack of momentum. And I do not necessarily look at that from a bearish perspective. I look at that from a bullish perspective, as in, what do I want to see in order for price to actually to confidently say that price wants to reach for that monthly fair gap? And I'm not getting the signs right there that price indeed wants to continue higher. So if price is not continuing higher, then what is it doing? It's likely continuing lower. So here we have a bullish candle, we have a bearish candle, then we have a second bearish candle sitting right there as well. And you could argue here, well, we have a 4-hour fair value gap right there, which we can simply just continue higher off of, right? Yes, that is true. But this 4-hour fair value gap is a lot different from a fair value gap if it were to be created right here. If we had a 4-hour fair value gap sitting right there, exactly with the overlapping highs, it's a complete different story. And the reason for that is because this candle and the second candle is creating a bullish fair value gap. Yes, correct. But what is it also doing? It's also respecting premium arrays because it's sweeping this high right there. So it's respecting a premium array and then coming into a fair value gap, which to me is not something I would want to trade off of, because then you are sort of trading against the momentum of the respect of the premium array, which is very important to understand. You're trying to sort of stop a train with your bare hands. It's not going to end very well. So here, this is not a fair value gap I would expect to hold right there. Again, this is where it's a lot of different variables. It's a pretty easy to understand logic behind it, as in the steps right there is simply, we have premium array, fair value gap being created, premium array is respected, we come back into the fair value gap. Fair value gap is not a good fair value gap. You don't want to trade off that fair value gap. So we can make a step-by-step process from it, but it's never set in stone. That is very important. So here, this now becomes a potential manipulation gap, where this becomes the bullish side, the bullish fair value gap of a sharp turn potentially. But how do we already know that that is potentially a sharp turn? Well, because this right there, that candle is what? That candle is an expansion phase of a new fair value gap potentially. So how do we actually know that this is going to be an expansion phase and is going to create a new bearish fair value gap? That is going to be known by looking at this first candle sitting right there. Because very simply said, this candle, the low of that candle, should not be traded back into right there if we want to create a new bearish fair value gap. So what does price eventually do? We do not trade back into that low right there, and we create a new fair value gap lower. This now created a sharp turn off of what? Off of a premium array. So a lot of people here, and I've been in this boat. So again, when I say all these things, I'm not blaming anyone. I'm more so talking from my experience, because I have been in this exact boat where I would expect at first higher prices of a potential this breaker right there, ignoring all the signs that we potentially want to continue lower. And we had perfect signs actually that we wanted to continue lower. And then saying, well, we can come into that breaker. We still have the overall flood and lot right here as well, because this leg should be respected. So we can have a heavy retracement right there. No, we can't. We simply can't. And the reason for that is because this area is overall as well fair value area. So we do not expect a heavy retracement into that in the first place. And if we are not offering fair value, then what are we doing? We are going for liquidity. Liquidity in the form of these lows. So even though we have fair value gaps higher, you could call it an order flow lag. This is not an order flow lag that you would want to trade off of. This is something where you will want to look for shorts right there on the dollar, which of course equates to EU, for example, longs. So that is very important to understand right there as well. Where if we take a look at EU, we have the exact same example, just inversed. We have this low that we reached right there. This low created this fair value gap lower as well. Again, this third candle is already a candle that I do not like. It's a candle where it just almost tells us, all right, I am not willing to respect the fair value gaps because I'm respecting a discount rate right there. So I do not like that third candle. It's a lot of momentum coming into the fair value gap. Ideally, you want your third candle to be a consolidation. A very simple consolidation where we can come into to then continue lower off of that. Because when it's a consolidation candle and it's not a big momentum candle like that, then a consolidation candle, of course, there's no train to stop. As in, there is no momentum to stop. There is no momentum at all in the first place. So the momentum is overall still bearish in that case. Where here, the bullish momentum starts to kick in all of a sudden off a discount rate. So that is very important. So right here, this is also where then, of course, the target becomes this high right there. Now, eventually, to look at this price action a little bit more as well, we can potentially still look to continue lower, but we want more clear signs, where here we have a new 4-hour value gap. We are potentially confirming order flow with this next 4-hour candle as well. So then we can still look to target lower. It's just important to understand how we then treat that order flow lag lower as well right there. So that essentially is a manipulation gap, but I'm going to give you one more example as well, which is again on US dollar JPY. Because on US dollar JPY, we had the same exact price action daily fair value gap, and now we look at our entry pattern. So the manipulation gap here is not going to be responsible for our bias. Well, you could argue it is, because an entry pattern is essentially just a bias on the lower time frame. But this is where we're going to use it for our entry pattern. So the manipulation gap is where we would want to see manipulation into the discount rate, into that daily fair value gap, to then create an opposing, a bullish daily fair value gap right there, to then trade higher off of that, which as we know it, creates a sharp turn. Where this right here, the first fair value gap of a sharp turn. So if you have a bullish fair value gap, it's going to be, if you have a bullish sharp turn, bullish ST, in this case, then you would want to see the bearish fair value gap be a manipulation gap. If we are expecting a bearish fair value or bearish ST, like on the dollar, then the bullish fair value gap is going to be the manipulation gap. And this right here is the manipulation gap, and that's quite important to understand, because we can see we are not continuing lower off of that. We disrespect it, create a new bullish fair value gap higher off of that, which that bullish fair value gap higher right there becomes a very strong, very high probability fair value gap as well. And that exactly is sharp turn. In other words, the first part right there is a manipulation gap. So if we now move on from section 6 to section 7 right there, it's definitely one of those PowerPoints and one of those videos as well that you might have to go through a couple of times, because it's quite a lot of information as well to take in. That's why it's important what I mentioned about the foundation enrollment and the advanced enrollment. Section 7, mitigated gap. A mitigated gap is also part of the manipulation family. So manipulation gap and mitigated gap are both part of that manipulation family. The rest is all part of that momentum family. Then the first step in a mitigated gap is that we do not have a new fair value gap. Now, no new fair value gap can be seen through two ways, where usually, we can look at it from a perspective as in we come into a previous fair value gap and we do not continue higher off of that, or we do not create a new fair value gap, a lower or higher off of that. But in itself, every single candle also has the chance to create a new fair value gap, right? So it does not necessarily need to be of a previous fair value gap. And I'll show you the examples, of course, later on as well. Then right here, the first step is no new fair value gap, the lack of a new fair value gap created. And that, as we know, creates unusual context. So where we expect momentum to happen, it doesn't happen. So manipulation is happening. So instead of the usual context, and usual context is just goes hand in hand with the momentum, with just a fair value gap or a breakaway gap. But unusual context is where momentum is not happening, manipulation is happening. So we do the exact opposite. We don't do usual context, we do unusual context. So the second part is expansion phase. Marking out every expansion phase candle. And what this looks like, I'll show you as well in the chart. Then the third one right there is the first candle. The first candle is crucial. It will tell us, it will tell us about a mitigated gap. So what does a mitigated gap look like in the chart? Well, at every turning point in a market, because we also see it here at US dollar JPY, we see a mitigated gap happen most of the times. Unless it is also a manipulation gap, then you might not see it. Then you would have a textbook ST as we know it, where the bullish fair value gap is perfectly overlapping with the bearish fair value gap. In this case, that is not the case. And what we are seeing right here is we first come into the bearish 15-minute fair value gap right there. And we can see that we do not continue lower off of that in the next candle. So this candle, based on candle signs, is telling us it wants to continue lower right there. Which, what is it doing? It is clearly not doing that. So here you would now expect, all right, this is a manipulation gap, this is now a sharp turn. Now we can look at higher prices. For this to continue higher, what does it need to do? It needs to create a bullish fair value gap right there. If this does not create a new bullish fair value gap, then this in first instance is not really coming off of a previous fair value gap on the same exact time frame. So it's not your typical mitigated gap that we saw right there with the bearish fair value gap. But this is going to be a mitigated gap if it trades back into this high right there. And this is where the first candle that we talked about and the expansion phase that we talked about in the PowerPoint is important. If you do this for every single candle, and this is going to be extremely beneficial for your trading if you start doing this, you look at the expansion phase and you can understand right here, there is going to be, or there can be, there's the potential to be a new fair value gap higher to be created. What would us, or what would avoid us from creating that fair value gap? If we trade back into the first candle high right there. Very simply said, just looking how a fair value gap overall is being created. So if we trade back into that, this is also going to be a mitigated gap eventually, where we can look to target lower and we have unusual context again. If not, then we just simply have a fair value gap that we can continue higher off of, and it's still in that momentum bracket overall. So, for example, what do we see right here? Here, we would expect this to be potentially a breakaway gap because we have a new expansion candle right there, a new expansion phase. This new expansion phase is where we can create a new fair value gap higher right there as well. And for us to create that new fair value gap right there higher, what would it need to do? It would need to stay above this line right there, above that first candle line, the first candle high right there. Because simply said, that would create a new fair value gap higher. And when we then trade back into that level right there, what does that indicate? That indicates to us that we are not reaching, or we are not creating fair value gap, so we are reaching for a lower discount array right there, in the form of the breaker, in the form of the fair value gap sitting right there. So that is important to understand, because if this formation happens on the higher time frame, you have the next few candles to trade back into this level right there, because it did not create a new fair value gap higher. That is very important to understand. So let's see if we can find some higher time frame examples as well. Let's see. On the daily, for example, let's actually take a look. This is also, of course, another example right here, where we have this high right there of the first candle. We trade back into that. And then this area becomes sort of your unusual context area from this level towards that fair value gap, because that area right there, this gray area, is where it's very high probability and where we know the drawn liquidity is almost set in stone. So if this happens on higher time frames, etc., then it becomes quite clear on what we actually want to be doing on the next few candles as well. And that is very important to understand. So let's actually take a look at this one right here. It's the same exact thing where we expect higher prices, potentially new expansion phase candle right there to be created. If it wants to create that, then this right here should not be traded back into. And once it trades back into that right there, from this moment, now the drawn liquidity becomes quite clear. Because now the drawn liquidity with this fair value gap below it as well is the drawn liquidity, very simply said. So at this moment in time, every single fair value gap lower that you might have right there on the daily, on the weekly, whatever it may be, that can be traded to then trade back into this fair value gap sitting right there. This is going to be very beneficial for you in a filtering process trading plan. But you might have guessed it, it's going to be extremely beneficial as well for you on a flow trading plan. And why is that? Because here we were creating this daily fair value gap right there. At this moment in time, we did not have a daily fair value gap just yet, right? So we are in the middle of creating a daily fair value gap potentially. So here, what do we see? Well, we can still look to continue higher already. If we want to continue higher though, then what should price action do at this moment in time? We have this premium array right there, which at first I'm not really expecting lower prices off of. You don't even need to expect lower prices off of that, right? You don't need to know where we are continuing lower off, because the fair value gaps will tell you. Sooner or later, they will tell you on what it exactly wants to do. Where here on NASDAQ, if we want to continue higher, we should create a fair value gap higher as well. So we should not trade back into this first candle high right there, which on the next candle we do. So at that moment in time, once we see that on the 5 minute, for example, and we see this formation right there, this exact formation, we see a sharp turn being created, mitigated gap actually right there, sharp turn being created as well. We trade back into this first candle high. What does that indicate? That indicates that we are not creating a 1 hour fair value gap higher, that we are not respecting the fair value area overall. So this right here, all this is liquidity right now. So the 5 minute fair value gaps that we are having right there are actually great fair value gaps to look for a trade off of to continue lower right there towards that target right there. Which, if we look at another example, a day later, let's see, on the daily, we were expecting higher prices off of the daily fair value gap. And at equities open, we saw actually a sweep right there. We come into this swing low right there, and we basically disrespected every ST, every read that we had already on the right side of our chart, which of course is not great, but we had equities open, so it's not that crazy. That can definitely happen. Then at this moment in time, right here, we are potentially sweeping this low. Now, there's multiple indications we can get in order for us to actually see if we are sweeping a low or if we are continuing lower or continuing higher, all that. So here, if we want to sweep this low, then a great indication could be that we are not creating this bearish fair value gap. If we are not sweeping that low, then what is another great indication? That we are creating a bearish fair value gap and we can continue lower off of that bearish fair value gap. So here, this next candle is going to be important. And this is a very easy way of reading candles, reading candle signs, reading fair value gaps right there. Right there, we do not create a fair value gap lower. Perfect. That is another bullish argument overall. And then eventually we create a bullish fair value gap higher as well. And we can see we never created a bearish fair value gap. And we do create a bullish fair value gap right there. That is how you go about the mitigated gap as well, which is extremely important to understand. It is reading those candles and reading, but also understanding where fair value gaps should actually be created. That is crucial to understand. So moving on from section 7, I promise you this is the last section, to section 8 right here. This is going to be your own studying until we meet again on Saturday, where we go over the breakdown and we go over questions, etc. on what we discussed in this week. Then your study is going to be mainly marking every single candle. And what I mean by that is, if we simply go over NASDAQ right here in live and in real time right now, then if we go over marking every single candle, we currently see this fair value gap right there. We also see that we did not create a new expansion phase right here based off of that candle right there. So this allows us to potentially, with equities open in 4 minutes, to trade back into this, to then continue higher off of that, instead of a new fair value gap that could be created right there. See, on the 1 hour, what are we actually doing? On the 1 hour, we should stay above this high right there. So even though we have equities open coming up right now, it is very important to understand that we should not trade back towards that level, because if we trade back towards that level, that means there's no bullish fair value gap being created, which means we actually want to or might continue lower right there. So we can also see that we can sting back into this 15-minute fair value gap, but not too far, because if we sting too low into that, then we are not creating a 1 hour fair value gap, which would not be ideal, of course. Look at the 4 hour. What are we doing? On the 4 hour, it's the same right here. We are creating expansion phase candle. So we still have 30 minutes overall. So this is takes a little bit more time, but same premise. If we want to continue higher, we should not come back into that first candle right there. And if we do this for every single candle out there, then it becomes very clear, or if we want to create this daily fair value gap higher, we should not trade back into this high right there. Then here, it becomes almost very clear that we still have bullish intention. We still have bullish momentum at this moment in time. And we can still reach for just the next drawn liquidity, which in this case is the previous day high right there. So it becomes very clear what the momentum actually is. Where, of course, if we do trade back into those levels, it's still, we are not necessarily wrong, but we do see that the momentum is changing. So we can, again, that creates an opportunity, where if we don't have the bullish momentum and we create a bearish momentum, that creates just opportunity. Not the opportunity you initially expected, potentially, but it is opportunity, because then you would just shift your bias, which is why it's so important to have an open mind. Because if you have a closed mind, it's going to be very difficult actually to switch your bias around, because you're going to be so stuck up on focusing on your bias, and you should be right all the time, that it's just going to be detrimental overall. So here, I actually want to see how this plays out eventually as well, and try to read the fair value gaps. With the fair value gaps, we know so far, that we have learned so far, which is the breakaway gap, which is also the overlapping gap, which is also, of course, the fair value gap, the manipulation gap, and the mitigated gap. So here, this is, of course, in first instance, it is what? It is essentially a breakaway gap. So here we can potentially already continue higher off of that. Now, equities open is where we have a lot of volatility coming into the market as well. So it would not surprise me if we do come back into the breakaway gap to continue higher off of that. And if we do that, then we just need to know the overlapping right there is not in the conversation. As in, that is not something we would want to come back into. Then we would almost expect lower prices right there. So either we already continue higher and we try to catch the next fair value gap potentially, or we retrace right there, come back into that fair value gap to then try to look for a new trade higher right there. So see, on the 5 minute, do we have something higher on the 5 minute? On the 5 minutes, if we do read the 5 minute candles right here, which again, if we are talking about a flow trading plan, I would not use the 5 minutes necessarily to get to a bias. I would use it for entry, but bias, not necessarily. Here we can see it is trying to expand higher right there, and equities open. The next candle on a 5 minute basis should simply said continue higher. And if it does not do that, of course, with the volatility coming in at equities open, is going to come into the 15-minute fair value gap to potentially continue higher off of that. This is weird. Why is this weird? Because this is now continuing lower, and at the moment it started to continue lower, it was weird. Why? Because the next candle, at the moment of that open, and to quickly use the replay tool, at the moment of this open, it should just continue higher. It has no other reason to come back lower unless it wants to reach for the 15-minute fair value gap right there. So Eventually, this is also unusual context. So on the 1 minute, what does that create? On the 1 minute, if this becomes a 1 minute fair value gap, that potentially becomes usual context to trade into the 15-minute fair value gap. But let's not get too ahead of ourselves, because that is, of course, being all over the place. Let's first wait and see what we want to do if we want to trade back into that 15-minute breakaway gap. And let's see if we want to trade back into those levels right there as well. Right here, we are in the 15-minute fair value gap sitting right there as well. And if we want to continue higher, then here, this is where we now expect, potentially on the 1 minute, this right here. Again, at first we expect momentum, right? So we expect lower prices. So we need to be proven wrong almost. So we need a manipulation gap to happen right there to then continue higher eventually. That is very important. So let's actually see what we do want to do right here. To mark it out properly, let's delete the 5 minute as well. We can delete the 4-hour line because the 1-hour line is basically the same. It serves the same purpose right there, so it's not super relevant overall. Let's see. This is if I were trading actively as well, I would just simply set alerts and walk away. And the reason for that is because it's not super relevant to look at how every single candle is forming right there. It takes a while for all those candles to form. So now we have potentially, and again, very much potentially, because it's nothing set in stone. We have this fair value gap that could potentially be a manipulation gap. We create another one lower, then that would become a new manipulation gap as well. Again, remembering, ideally, we should not trade back into this level right there, because that fails to create a 1-hour fair value gap as well, which is of course not ideal right there. Let's see. And 15 minutes, we can see the exact same. In 12 minutes, we are potentially closing with this expansion phase candle right there. So already actually, we can mark out this first candle. Because do we prevent from creating expansion phase candle? Do we prevent from creating a fair value gap as well, lower? That is a great indication that we actually want to continue higher right there instead of continuing lower. Because if we continue lower right there, then this 15 minute will simply say create a 15-minute bearish fair value gap right there. Now, if we look at the 15 minute, then we can already see there is something happening on the 1 minute right here. 1 minute. So ideally right here, this is where we now create a 1 minute bullish fair value gap if we do want to continue higher. And this manipulation gap should now, like it does right there, did you see the small little rejection we had right there on that candle? The small little rejection we had lower, and the rejection we currently are seeing are the rejections off of this 1 minute fair value gap. So once those rejections are done right there, and we create a new 1 minute fair value gap higher right there, then I would expect the 1 minute fair value gap higher right there to hold. If we never get a 1 minute fair value gap higher, and like we're currently seeing, we might continue low right there, perfect. Then we are just simply still waiting. We're just going over all the possibilities and setting our expectations right so we know how to act when it does happen. So let's see. All right, we do continue higher right now. We already had a rejection. So right now, what is important? Ooh, did you see it? Almost right there. I wanted to mark out, I was too slow. If we trade back into that level, that will of course also tell us a lot. So ideally, the next, and there it is. There we do trade back into the level. So we still do nothing right here. We still wait. We still wait because we did not get a new 1 minute fair value gap higher right there. And let's see. Let's see what we want to do. Do we want to create a 1 minute fair value gap? We're trading back into this level, which is a great indication that we do want to continue higher with these highs overall being the target right there. Only thing is right now, what's stopping us from trading is that, of course, we would want to have a 1 minute fair value gap higher right now. So let's actually see. 6 seconds, 5 seconds, 4 seconds. Okay. So currently we do not create a new bullish fair value gap again. Does that indicate to us that we still want to continue lower? Could definitely be the case. This is still not a manipulation gap, right? It's a potential manipulation gap, but it's still not a manipulation gap. Why? It never created a bullish fair value gap. So we never have a sharp turn. We never created a sharp turn right here. That is very important. And the last area where we can actually look to create a bullish fair value gap is this area. which of course we can still look to continue higher off of right there, but that's a very small area to actually then reach the draw on liquidity. So it might just reach the draw on liquidity even before we get any fair value gap on the 1 minute right here. Same premise, because we are respecting the overall breaker, this candle that is currently forming should be a down candle, right? Next candle should create an expansion phase lower if we do want to be bearish. If we want to be bearish right there, then the ideal price action is this next candle that's currently forming right here should be an expansion phase continuing lower, because that creates a bearish fair value gap continuing lower, where it should not trade back into this candle right there. Why not? Because that creates a bearish fair value gap. Again, all we're doing right here is simply reading price action. It's just understanding this candle rejected, next candle is a bearish candle. Perfect, perfect. If it was the up candle, would have been weird. Next candle should be an expansion phase, because it's not going to consolidate again. If it consolidates again, it's going to be a bullish candle right there. But right here, this is where we should not trade back into that level right there currently, because that would again be suspicious. And this is what we know as a resistance area, right? We're in the 50-50 area, because we come into the first 1 minute area where we can still continue lower from, and the first area on the 15 minute, the overall PD rate, the context, the boundary, where we expect higher prices. So the first area here is what you'll see as a consolidation. And until we have played both rejections and we create new fair value gaps higher or new fair value gaps lower right there, that is when we truly see price following through. So right here, what are we looking at? We have a bearish fair value gap potentially in the making, which is great because that indicates to us that we do potentially want to continue lower as well. So let's see what it actually wants to do. Let's see. So at this moment in time, there it is. Perfect. We have an extremely aggressive move higher right there, which again indicates that we created an expansion phase candle. We did not create a fair value gap. So currently, have we played out all the rejections? And now this is where it gets interesting, because we have had the rejection lower, basically from the whole leg. So the only reason why we might be continuing higher is to create a bullish fair value gap higher to target these highs right there. So in an ideal world, what would I demand of a price? What would I like to see of a price? Well, I would like to see a new bullish fair value gap higher right there to then target the highs. If we do not get that, perfectly fine, then I'm just simply not getting involved. And I just save another percentage to risk on another trade. So let's see what it wants to do. Again, here, this is an area where you want to wait for a fair value gap higher or fair value gap lower. The reason for that is because this is your 50-50 area. This is the resistance. The fair value gap higher right there, that is when we have no resistance anymore. That is very important. Let's see. Not creating an expansion phase currently. Let's see what the next candle does want to do. It wants to consolidate as well, or finally create an expansion phase candle again. If it trades above that first candle, there it is, trades above the first candle. What do we want to see? Ideally, this right here should now create a fair value gap right there to continue higher. If it again does not do that, then we still wait. Then we still wait and we don't do anything. So we should stay above this line sitting right there. Which we can see we are currently not doing. We still have 15 seconds to go until the candle closes right there. Do we want to create a bearish expansion phase? Could also be the case. There it is. Let's see what the next candle wants to do. Simply said, again, for our study, we mark out the first candle again. And what do we see? We don't create a new bearish value gap. All right, so we still wait. We took we took some price action right here. We took the exact consolidation price action right there, but it's okay. It's okay. Let's see, this first candle will be very difficult to create a bullish Fair gap, but the second candle could do it. Why is that? Because there's a candle between it. So the next candle, this candle would need to expand above that candle to create a bullish Fair gap. Where the next candle is quite easy because there's an easy path right there to create a bullish Fair gap in the form of this. Because it then needs to trade above this candle right here instead of that candle. Unless this is going to be an extremely low close again, or even a bearish candle right there. And of course, yes, that is also going to be quite difficult. Like this. All right. Showing us a lot of momentum, but not doing a lot. Overall, the bearish Fair gap right there is currently, of course, still winning. But this right now is what? It's also a mitigated gap. Why is that? Because we are not creating a new bearish Fair gap off of that. So the bullish right here, the bullish intention could definitely be there. And this is where, again, what we talk about, it is extremely 50-50. So what do you want to do? You want to wait for any Fair gap higher or lower. And those Fair gaps lower should target this low, Fair gaps higher should target this high right there. That is ideally what you would want to see and what you would want to wait for, Fair gaps higher or Fair gaps lower. All right, there it is. Potentially again. The best thing if you were trading this live, by the way, on how you want to approach this is you would want to walk away, just simply set your alerts on when fair value gaps do form, of course. In the meantime, it's not really interesting to stare at a chart like this. Let's see if we can quickly look at EU as well, because that was also quite interesting. Let's see on EU. Because EU right here, if it wants to continue lower, we do the exact same thing. We have this 4-hour value gap right there. We continue lower off of that. Perfect. Then this is the part we should not trade back into before we actually trade back into these lows right there. So here on the 1 hour, let's also look at the 1 hour. 1 hour is having a 1 hour value gap there as well, but it would still worry me if we do not create that 1 hour value gap right there, because then we have a very hefty retracement to make into that value gap to then continue lower off that. Also doesn't make a lot of sense to me. So on the 15 minute, let's see. 15 minute, ooh, is not that clean actually. I prefer the 1 hour right there and the 4 hour. But the 15 minute, if it wants to create an expansion phase, then it should not trade back into this first candle, which is not having a lot of room, because right there we have 30 seconds before we actually close. So this is almost definitely going to trade into that first candle right there. So then I would prefer ignoring this and just simply trading off of the 1 hour that is potentially forming and the 4 hour right there. It's a quick peek at NASDAQ again, because a 15-minute candle is closing. So this next candle right here is also going to be quite interesting. Why is that? Because we have this right now. We have an expansion phase going lower. If that creates a bearish fair value gap, that's not going to be ideal. Now, ideally we want this to either, because we did close inside the fair value gap, so it can still sweep this low to then continue higher. But we just simply want, if we want to look for high prices, we want to close in this area right there, because that is going to create a bearish value gap, which is not ideal, of course. On the 1 minute, Again, this is definitely a low that we could still sweep to then continue higher off of that as well. As long as we also understand that ideally on the 1 hour, we should not trade back into this level. So again, when we then combine it with timeframes, I can also understand that it is quite a lot, but this is only if you focus on NASDAQ, for example. If you only focus on a flow trading plan, then this is going to be a lot easier, and all you have to worry about is the timeframes right there and seeing what they are doing. It's also creating a habit of what price is doing and constantly switching between the timeframes right there. It's taking its time. Never created a bearish fair value gap in that leg, which is also, we could argue, is still a great bullish argument overall if we do want to continue higher. And if we do not want to continue higher, then we do have a 15-minute fair value gap lower being created as well right there. So now it becomes interesting again, because if we want to sweep this low, then what would we want to see? Ideally, a bullish fair value gap being created as well. And if we do not want to sweep that low, then we want to continue lower right there. Then what are we likely going to see? A close below that low, creating a new bearish fair value gap below that low as well to continue lower off of that. Going lower off of the fair value gap area right there. If we are sweeping this low, then ideally, of course, we should not come back below it right now. And if we are coming back below it, then it's not a great sign that we do want to continue higher. Can we get any sort of fair value gap? That would be nice. All right, there we have a potential expansion phase candle, but I've spoken too early on a lot of these candles, so let's wait. Let's wait. I think we all know right now what we need to see in order for us to have good price action. What do? We mark out the first candle right there. And this is the room of margin it actually has right there. Where currently the room is getting very small, very small. Right there, this would be the fair value gap if we do want to continue higher off of that. We still have 50 seconds. Let's see how this, if the fair value gap wants to be created, let's actually see what it wants to do right there. Very small. Oof. Uh-oh. Again, very small. 15 seconds, 10 seconds. Is it going to leave behind a fair value gap or not? That's the question. That is the question. 6 seconds, 5, 4, 3. All right, we have a fair value gap right there, which we can see price actually setting up very nicely to trade back into it right there. Now let's try to read the next few candles, how they form, because this candle right there, the rejection is already very nice. Ideally, when we already have a rejection like that, what should we expect off of this fair value gap? A new fair value gap higher being created right there to then eventually target, well, we have to take into account right here that we are also creating potentially a bearish fair value gap. So ideally the first target is this right there. If we create a bearish fair value gap in the meantime, then the target will be the bearish fair value gap instead right there on the 15 minutes. See, on the 1 minute, we are expanding higher. There it is. And now it's basically following the same thing over and over. And it will tell us a lot if we do not want to trade or if we trade back into this level. This level is very important. It's a key level right now. Ooh, is it? It is a fair value gap actually in the making still. It's a very small area, but it is a fair value gap right there. A key area again, very, very key area. Even though we do not create that fair value gap higher right there on the 1 minute, the thought process here is it's still very important to see what we want to do with this 15-minute level right there. Because if we trade back into that, I still expect, even though we did not create a 1 minute fair value gap higher right there, I would still want to see higher prices overall. And we can also see it becomes a very small fair value gap, right? Which is also not the best sign that we actually want to continue lower. So let's see what we want to do right here. Let's give it around 9 or 8 more minutes right here to see what it actually wants to do. And we can see the exact same thing though, that we are continuing lower right now, where this was on the higher time frame, then what would the target be? This low right there. Why? Because this did not create a fair value gap high right there, come back lower, and this swing low would be the target right there on the higher time frame. And then you would find your usual context in the unusual context right there as well. So let's see, if we want to continue lower, what should we do? I'm going to give it 7 more minutes right there, purely because I want to see if we do trade back into this 15-minute level right there. It's the same premise. If we now come back below this low right here, it's the same premise that would not be ideal. We should already continue higher right here off of these fair value gaps, which we tried to do, but we failed to do so right there. Then this is a potential bearish fair value gap as well. Will it create a bearish fair value gap or? There it is. All right, bearish fair value gap sitting right there. Which in this case, I would not really expect a move into that fair value gap before we reach those lows right there. Why not? Because we have this candle right there, the large candle, the third candle of that fair value gap is a very large candle. So for it to make that retracement is quite a hefty retracement, like I always mentioned, to make before we actually reach those lows. So the question here is, this is a breakaway gap. So the question becomes, draw on liquidity or fair value gap first? Well, based on this candle, I would argue draw on liquidity first before the fair value gap right there. And if we do retrace into that fair value gap, of course, then the argument would be, all right, well, do we actually not want to continue higher still? That's very important. Fail to create this fair value gap right there. It's also, of course, good to note down. We trade back into it right there. Then are we potentially creating a mitigated gap or a manipulation gap to continue higher as well. Let's see what we want to do. Currently respecting it. All right, there it is. And now it's quite clear where the next candle I would want to see lower prices right there. But we've been consolidating for a little bit, so it wouldn't surprise me if it does the exact opposite. And this creates a new bearish Verwijker, potentially lower as well. That would be ideal to see. Simply said, because we are coming into the breakaway gap, and I said as well that ideally I would not want to see a retracement back into that breakaway gap. If we do, and we do respect that right there, then the next candle should just be bearish as well, right there. And again, this is on a 1 minute time frame, but let's say this was on the monthly time frame and we respected it like that, then of course we have a lot of candles to deal with right now. And let's see, because after this, then next target could become this 1 hour Verwijker gap right there, or the 1 hour Verwijker gap that is failing to be created. We see on the 15 minute, we are creating a 15 minute ST as well. 15 minutes Verwijker gap lower right there. We failed to create a 1 hour Verwijker gap lower right there. On the 4 hour, let's see, 2 minutes and 50 seconds before we have potentially an expansion phase, or we do not have an expansion phase on the 4 hour. So that will tell us a lot on what price action potentially wants to do for this day. On the 1 minute, what you would want to see ideally, if we do want to continue lower right here, then this is exactly what would indicate for me that we do want to continue lower. The first sign is a Verwijker gap, exactly overlapping with the lows right there. Now once we have that, this is the area of fair value. So if we want to continue lower, then this area right there, which we are currently setting up nicely, can you see the third candle that is currently forming? Setting up nicely to trade back into that Verwijker gap to potentially continue lower off of that right there. If we do not continue lower off of that, and we do not offer fair value, then what do? We likely target liquidity. So it's very funny because a lot of times, and this is also flow trading plan, right? So we also have to understand the difference. But a lot of times, a usual trader's mind is, all right, we need to do this and we need to go higher and we need to do this. We are constantly switching because we just don't know. We don't know exactly what price wants to do. It just depends on what price will tell us on what it wants to do. So we are constantly keeping an open mind and we are switching between what price actually wants to tell us. And we go off of that to see, all right, well, if it tells us this, then it potentially wants to do this. That is the highest probability for it to do next. So let's see, we actually have 1 minute to create a potential expansion phase right there. But we can also see that, look at this long wick right there. Very, very long wick right there, continuing lower potentially. So that is definitely something to take into account. And right here, if we do want to continue higher on the 1 minute right there for a short period of time, then we can also see right there that I would actually want to see this next candle be a bearish candle. If that's not a bearish candle, then that is not a great sign that we do want to continue lower already. Simply said, because we are already respecting this on a 1 minute basis as well. So here, if we do want to continue higher a little bit, then what can we look to target? Well, then we first of all have this again with the same 15 minutes Verwijker gap right there, the principle. Next target could be this 15 minutes Verwijker gap sitting right there. All right, there it is, 10 a.m. So right here, what I want to do is I would love for you to study this price action further. You don't need to keep sticking to your chart and be glued to your screen and constantly study it. But what I would love for you to do is potentially at the end of the day, so that is around, 4 p.m. New York local time. Then you can look at this price action again, study what happened, where did the fair value gaps get created, where did the fair value gaps not get created, and then see how we react off of that. So when it's on the website, by the time you're watching this probably, then you can also just study it after the video right here. In the meantime, I'm going to end the recording right now, and we are going to go over live masterclass questions as well. Let's see.